Hey everyone, welcome back to your channel name, where we break down complex trading concepts to help you become a better trader. Today we're diving into one of the fundamental concepts in technical analysis: support and resistance. Support and resistance levels are key areas on a chart where the price tends to reverse or consolidate. These levels act as psychological barriers that influence the movement of prices. Let's start with support. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. As the price of an asset declines towards this level, buyers become more inclined to buy, creating a floor that prevents the price from falling further. Here's an example on the chart. You can see the price approaching this level multiple times, but failing to break below it. This is a strong support level. Now let's talk about resistance. Resistance is the opposite of support. It's a price level where an uptrend can pause due to a concentration of selling interest. When the price approaches this level, sellers step in, creating a ceiling that prevents the price from rising further. In this example, you can see the price struggling to break above this level. Every time it reaches this point, it gets pushed back down. That's a strong resistance level. But what's happening behind the scenes? Why do these levels hold such importance? Support and resistance levels are created by market psychology. At support levels, traders believe the price is too low, so they start buying. At resistance levels, traders think the price is too high, so they start selling. This collective behavior creates these critical levels. Now that you understand what support and resistance are, how do you identify them on a chart? There are a few methods. The simplest way is to look for areas on the chart where the price has repeatedly reversed or stalled. You can also use technical indicators like moving averages or Fibonacci retracement levels to help spot these areas. So, how do you use support and resistance in your trading? Traders often use these levels to make buy and sell decisions. For example, you might buy near a support level, expecting the price to bounce, or sell near a resistance level, anticipating a reversal. Remember, though, that no level holds forever. That's why it's essential to use stop losses to protect your trades if the price breaks through these levels. One thing to watch out for is false breakouts. Sometimes the price will break through a support or resistance level, but then quickly reverse. This can trap traders who entered the market expecting a breakout. Here's how you can spot a false breakout. Look for a quick reversal after the break and low volume during the breakout. These are signs that the breakout might not be genuine. Support and resistance are powerful tools, but they're not foolproof. Combine them with other indicators and strategies for the best results. And that's it for today's video. If you found this helpful, don't forget to like, subscribe, and hit the bell icon so you don't miss any of our future content. Drop a comment below if you have any questions or if there's a topic you'd like us to cover next. Thanks for watching, and happy trading!